What's going on, guys? It's the Bulls and the Bears here with another Tasty Trade video. I'm feeling a bit under the weather, so if my voice isn't up to par, I apologize, but the show must go on, so here we go. Here's a Tasty Trade account, still dealing with a lot of red positions. I mean, these are going to be here for a while. If they're not working, then I'm going to have to hold them. I have a lot of time on them. They expire, most of them expire July 21st, so that means I still have a lot of time left, so they're going to be chilling around here. Still have about $900 in unrealized losses open. However, there is still stuff moving in the background. I've realized over, let's see, $160, just about 160 bucks in profits from the last video. They came from 4 trades. You can see them scrolling down below in the banner. Just 4 trades, not a whole lot this past week, but still $160 profit as I wait on these positions. A lot of these positions are bearish. I have a couple positions on FDX, Tesla, Netflix, Amazon, Apple, all short. So as you know, the market's been ripping up. These positions have been doing poorly. So I need a big market turnaround here over the next few weeks to see the light on these positions. But yeah, nothing really new there. The market is kind of coming down the past couple days, which is good for my SPX positions. But Apple, Tesla, Amazon, particularly Tesla, I mean, it's not budging at all. So we're going to review all those trades, all those positions, where they stand. But first, we're going to talk about some of the trades that I just closed. And since there's only 4, it's easy to talk about all of them. So we'll just go into them right now. Move over to Trading View here. So one of the first trades I did since last video was Alibaba. This was a bullish trade. I was watching this this pattern. I actually found this on Twitter. Had this Alibaba formation and some bullishness around the Chinese markets, possibly. And we're looking for a breakout of this trend line for us to move higher. That was the plan. So I decided to play a bullish trade. Let me actually, there we go. I did a bullish trade. I did the 85 put spread. So I needed Alibaba to stay above this level, basically right here. I opened it where I basically have that circle. I opened it before we broke out. And, you know, the very next day we gapped up out of this triangle and we kept pushing up. So that actually worked out perfectly. I didn't hold this too long and get 50% profit. I sold it for 176 bucks. And I bought it back for 111 and profited at 65. So if I just do the math on that, you know, so it's not a perfect trade. But if I do the math, it ends up being a 37% winner, 37% capture of the premium. The rule of thumb is to go for 50%. Whatever you collect and credit, you try to profit 50% of that. I got 37%, so not the greatest, but you can see Alibaba did roll over the past couple of days. And since I had somewhat of an aggressive strike on a name that I'm not, you know, too crazy about, I tried to take the gains while I had it. I mean, and if you think about it, it was a trade that was set that had 39 days expiration, and in only 3 days I got 37%. So yeah, it wasn't 50%, but it was 39% or 37% over 3 days. Just 3 out of 39 days to get that. So I kind of weighed that in as well to my decision, is the speed of which I got 37% of the premium. So I think that should be factored in, because if I did decide to hold it, I think I'd still be in it. We'd be, you know, this pop would be getting erased right now, and I wouldn't be feeling as great about it. So that was a nice 62 after commission, 62.46 on that one. Adobe was one that I'm shaking my head over. This was a bullish trade. I explained this one in my last video, saying, you know, I had a lot of short positions. Although Adobe is running up like everything else, I do think I should have some long skin in the game. On all the stocks that have moves like this, I've been shorting them. I think it's time I start to just join the trend on one of them. Adobe had earnings coming up at the time, so I decided to play a bullish spread, a debit spread, a call debit spread, where I bought the 485 call. Put that here. 485 call, and I sold the 490 call as a hedge, so it was a 5 wide spread. I paid $1.82 for it, which means I could have had a max profit of $318 if the spread was completely in the money. I opened that around here, I think. So on this day, when it was like during the red day. So let me maybe zoom in a little closer to the 15-minute chart. So I think I opened it around this time right here. So I went long when we were at like 475. So we didn't really do much that day. And then the next day we went sideways, kind of moved down a little bit at the end. And then on Thursday, the day of earnings, they reported earnings that night, we were starting to trickle higher. And I don't know, I got a little spooked off the trade, is really what happened. And because it expired that week, you know, it was a bullish trade for earnings. It wasn't like it wasn't a 40-day trade or a 40 days expiration. It was that week. So at this point, there was only like 2 days left to expiration. And I wasn't feeling the best about it. So I decided to just take it off for basically break even. I made like $5 on it. So I decided to take it off because it wasn't moving. I wanted to move faster, or sooner, I should say. It went sideways for 2 days. I wanted it to go up before that. And of course, after I closed it, it did rally a crap ton that day over 490. So my spread would have been entirely in the money. And then obviously after earnings, it went all the way up over 500. So it would have been a perfect, most likely a max profit trade had I decided to hold it. But I was scared off it, not gonna lie. So unfortunately, a nothing trade there. Another one was PayPal. This was another bullish trade. I sold a naked put on this one. It's a cheaper stock. The buying power requirement wasn't terrible, and I was feeling favorable on it, just given how bad it's been crushed. It's at some pretty significant lows, and I think it looked like it was starting to find a bottom. So I decided to play a short put at the $60 strike. It was 42 days out, so I sold it for 42 days out, collected $84 premium, and I closed it for $59 to profit $25 before commissions. After commissions, about $23.73. So $25 out of 84 is about 30%. So that's what I look for with naked options. Naked options carry a lot more risk. Outlier risk. If there is that dramatic move to the downside or just against you with a naked option, you stand to lose a lot of money. So because of that added risk, I like to take them off sooner. So instead of 50%, I go for 30% on naked options. So and I got that because PayPal had a really nice move these past few days. I opened it around, I was only in the trade for 4 days, so I must have opened it here, and then 1, 2, 3, 4, it went up really nicely, and that was it. Perfect trade. And the last one that was closed was actually closed today, and that was on FedEx. It was an earnings trade. I like to do these earnings trades. I like to look for the expected move, and I like to play an iron condor at or just beyond the expected move on both sides. It usually offers a pretty good risk reward, and you're playing favorable levels because it's the expected move, and you just play it for earnings. Like the very next day after earnings, you look to close it. It's the same week expiration. So that's what I did with FedEx. It was so I had earnings that it moved lower, but the expected move was about 3%. It was like 2.9%. So I round up for that to be more conservative. So instead of 2.9%, I did 3%, and then I figure out what number that is, and then I round that number up. So if it's like $244.20 for the upside, I'll round that up to $245. Just to be that much more conservative and safer. So that's what I did. I played these two levels, the 245 and the 220. The width on the call and put spreads were $2.50. I collected a total of $1.18. So I collected $1.18 and I was risking $1.32. So pretty much a 1-for-1. And it was in the expected move. It did move. It did get pretty low. I mean, my 220 strike, which was on the put side, was definitely tested a bit. I mean, we were only $3 away, but we did rally at the open. So we did move towards that put spread, which put that put spread under pressure. But after that rally, the first couple minutes, that spread was no longer under pressure. The entire iron condor was able to decay quite a bit. I ended up buying it back for $45 after selling it for $118, and it was a $73 profit after commission, $68.46. So that was a nice earnings trade. That's how I like to play them. An iron condor with the put and call spreads beyond the expected move, just beyond the expected move, and and then close it the very next day at the open. So that one worked nicely. A nice $68 winner there. And that pretty much wraps up the trades that I did from last week. Just 4 of them, not a whole lot, but $160 profit is always nice to add to the account. So monthly P&L realized is now $554. Year to date, just about $490. I do have a lot of losing positions open right now, but those go into July. So when the time comes, if I do have to take losses on them, that's going to be a July issue, and that could be a big issue. July could be a very nasty month, but as far as June is concerned, it should look to be a really good month, already at $550 and looking to add to it. So let's just update on the positions I have open right now, and then we'll call it a day. Starting with Amazon, I have a debit spread, a put debit spread. I have the 120 strike, the 120 put that I purchased, and I sold the 115 as a hedge. So it's a debit spread, and I need it to go below 120, preferably towards 115 for me to make my money. It is definitely stalling out up here in the 125, 124 region, which is nice. You like to see that upwards momentum stall out, but I need it to now fall. It's not enough for it to stall up here. I need it to actually fall down. So we'll see. Again, I have till July 21st. That's over 30 days. So I got plenty of time. But right now, not going so well. SPX, we'll go to SPX right now. It's trading at 43.65, coming off that major high. 3 red days in a row, possibly. That's very possible. But finally, I mean, this is warranted. We were overbought on the RSI. And the last time we were overbought on the daily chart was way back here in August when we had this massive sell-off. I'm not saying a sell-off to that magnitude is going to happen, but I'm just saying when you're overbought on an index like this, it's reasonable to expect some selling. And I guess the closest we got after that was right here. The RSI was not necessarily overbought, but pretty close at 69. Over 70 is overbought. This was at 69.14, and look what happened. It sold off quite a bit. Not just a 1 or 2 day pullback. I mean, it sold off over the course of a month or so. Will it be to that magnitude? I'm not calling for that. I would reasonably expect a pullback to like the mid 4200s, maybe 4200 exactly. But a pullback is definitely necessary or warranted. Even in a bullish trend, it would be a healthy move. And luckily we're getting that. But I need it to move lower because one of my spreads is at 43.50. Put that level right here, 43.50. I need SPX to be below this level by expiration, which is July 21st. So we're coming close to it now. Luckily, the spread is almost out of the money, but it's been in the money for quite a bit, and it's been at a loss for even longer than that. So need this one to work. And then the other one, I decided to open another spread on this, which is a little bit of a breaking a rule of mine to add to the same stock, same position, basically adding to a losing position in a way by doubling down on it. I opened one at the 44.75 strike. So I need SPX to stay below 44.75 and 43.50 for me to win on both trades. The 44.75 is looking good. That one's actually in the profit. I could check on that after, but still has some ways to go before I hit my profit target. While the 43.50 is still in the money, need this thing to move lower. Moving on to Apple. This is a call credit spread. I sold the 185 call. I need Apple to stay below 185 by expiration. We are now below it. 185 was beyond all-time highs at the time that I sold it, and it got it. It got above it. It got as high as 187, but now we're finally pulling back a bit, which is warranted. This was overbought too. Very big uptrend. Would not be surprising to see some profit taking and maybe some cycling out of this tech rally that we've had. The Magnificent Seven, Apple being one of them. Pretty much all these positions being the Magnificent Seven. Apple, Amazon, Tesla, all those. So pulling back, my spread is now out of the money, which is where I want it to be, but we're still pretty high up, so it's at a loss at the moment, but improving. Netflix, this is another call credit spread. Again, these are all short positions. These are bearish positions. I need these stocks to move down. And on Netflix, I sold the 435 call spread. So this is now out of the money too, as Netflix is moving lower, which is nice, but you can see it was in the money at a time. Netflix pushed up well beyond where I expected it to move. And now, luckily, it's pulling back, but it still has some more room to go. This is also at a loss because it's still very elevated from the time that I opened it. Tesla, this one is looking Very scary because I have the 245 call spread where the yellow line is. So this is like way in the money now. Like Tesla moved well beyond my spread and then some, kept going. Tesla had the tech catalyst. It's part of the Magnificent Seven, so it rallied like crazy. And then it got another catalyst with EV related stuff with Ford and Rivian announcing that they're going to be using Tesla's superchargers. So that was a further catalyst to continue the momentum, and Tesla just kept going and going. So again, I have until July. This was July 14th, not the 21st. So I actually have less time on this one. I have like 23 days, not 30, 23 on Tesla. So even shorter, even less time, and it needs to come down even more than the other positions I have. So this one's looking the worst and the least likely to succeed unless Tesla really does collapse over the next few weeks. But you know, it is what it is. It would be a total of a $348 loss. That does hurt. I think I'm down over 200 on it right now. So I still have another 150 in losses to accumulate if this thing stays above this level. But we will see what happens. A bullish trade I have is with Oxy, Occidental Petroleum. This is a naked put, just like what I did with PayPal. Ignore this yellow line. This is for the wheel strategy that I do on my channel. If you're interested in that, check it out. I have a cash secured put sold on Oxy in that account. But for my Tasty account, I have a naked put sold at the 55 level, way down here. So I need Oxy to stay above $55. A rally would help. I collected $84 for it. Like I said, I like to capture 30% of the premium when it comes to naked options. So I have that profit order out there right now. Definitely need a rally from Oxy as it has sold off the past couple days, making this trade a little bit red. And the last one I have is on VIX. This is interesting. But VIX has been obviously very low. This is the fear index. This is the volatility index, and volatility has been very low. I mean, the VIX is so low. We're at levels that we haven't seen since, I'm still scrolling, before COVID. Obviously, after COVID's created a huge spike, and there was just a lot of volatility last year. So you can see the VIX has spiked up quite a bit in the 30s and the 20s. Not a stranger at those levels over this past year or more. But now, with the market rallying and things seeming like sunshine and rainbows and everything's great and there's no need to fear anymore, the VIX has just been collapsing at really low levels, and it's been staying here. Today, I decided to buy a call on it. You can do that. You can buy a call on the VIX. I bought the 17 strike expiring in August, the August cycle, which is 55 days out. I paid $247 for it. I need VIX to rally by the time expiration comes, which, let me get a line here. I believe it's the August 18th. That should be the cycle expiration. There we go. And then I'll get the horizontal line while I'm at it. $17. So this is the range right here. I need the VIX to move up by expiration, by August 18th. The 17 call, if it goes in the money, that'd be great. Even if it goes up to 15, 16, I'm sure I'll have a nice profit and I could take it off there. You gotta remember, when VIX goes up, VIX is the volatility index. So if VIX goes up, volatility is going up too, because that's what it is. So that means the option premium that I bought a call, will expand as volatility goes up. So it's like a double whammy in my favor, where the VIX going up is going to help my call, because that's how calls work. When the underlying goes up, the call improves. But on top of that, I'm also going to get that volatility expansion, which is going to inflate the premium on the call itself, and I'll be able to get an even better price on an exit. So that's how that trade will go. It's looking to be at its lows, though. I mean, VIX is still pretty low. I think it's moved lower since I bought the call. I mean, it's just been trending low today. I mean, it's breaking the low of day as we speak. So, and not just the low of day, I think the low of this past, like, 52-week low or beyond that. Like, we're below all of these data points over here as we speak right now. So it's been getting crushed as volatility is really low and fear is really low. We'll see if that changes. It can change on a dime. You can see how fast these spikes can happen. Just 4 days, we go from 16 to over 20. That's a 4-point difference. That's a 20% move or more in just 4 days, and I have 55 days. So we'll see what happens. But VIX has been pretty low for a while. I'm calling for it to start going up. So that's going to do it for this video. You can see that VIX position right here at the bottom. $0 unrealized loss, so it's at break even right now. Tesla is down. It's moving all over the place, but I'm down about 200 bucks there. SPX is improving. On the 44.75 call spread is up about 20 bucks. Not a whole lot there. It's up 20 bucks while my 43.50 spread is down about 200. Oxy's doing all right. Netflix is down 80 bucks. Apple's down only 40 bucks, which is a big improvement. Amazon is down a lot, 350. However, the max I can lose on this trade is actually 332. So the loss you see here is actually more than the max loss I could take. That's because there was a lot of, it wasn't a debit spread to begin with, it was a diagonal spread. So the short leg that I had sold against it was at an earlier expiration than the long one. And I've been rolling that ever since. I rolled it a few times. And I've collected premium along the way, reducing my net debit. Now, TastyTrade doesn't account for that. I originally had a net debit of 465, but by rolling the short leg further out to expiration, I've collected credit, collected profits, and reduced my net debit. TastyTrade just accounts that as profits received and moves on, while I'm accounting for it as a reduction in my net debit. So my net debit is now 332, and therefore I can only lose a maximum of 332. So that's a little misleading there. But yeah, things are improving as the market is coming down a little bit. Will it continue? I don't know. I mean, I hope so, obviously, but we'll see. We got time, though. We got time. So that's it, guys. Thank you for watching. I hope you enjoyed. If you did, leave a like down below, subscribe for more content, and I'll see you all next time.